Hey guys, Joe Massey here with Castle and Cook Mortgage. Today is Friday, June 13th, so it's Friday the 13th. Hope you're not having any bad luck today. Hopefully everything is going really smooth for you with your buyers, your sellers, and on all of your transactions. Wanted to talk with you today about mortgage insurance. Last week I asked for some suggestions on topics that you wanted to learn about, things you wanted more information on, and the most popular response that I got was mortgage insurance. What is it? What does it do? How does it work? Etc. Mortgage insurance is a pretty big topic, so today we're just going to cover some of the basics, but then next week we're going to talk specifically about a couple of different mortgage insurance programs. So it's kind of a broad topic, so I wanted to break it out for you into two parts so you're not just sitting here watching me talk for the next 20 minutes. So first off, mortgage insurance, what is it? Well, mortgage insurance is a required insurance if the buyer is not putting down 20% for their down payment. And it's going to be required on FHA loans or on conventional loans when that customer is putting down less than 20%. FHA loans, it's required at all loan to values, so they might be putting down 25 or 30% or more, and it's still required. That's the defining characteristic of an FHA loan, is it has FHA mortgage insurance. Whereas a conventional loan, if you decide to put down 20 or 25%, you don't have to pay mortgage insurance. So it's an insurance that is covering the lender. In many years past and decades past, lenders always required 20% down or 25 or 30% down or more. The reason that is in the event that the customer didn't make their payments, the lender has to foreclose on the loan, and oftentimes the house gets beaten up, and when they go and sell the property after the foreclosure, they usually lose about 20%. Well, mortgage insurance came along and they said, hey, you know what? We'll insure the loan up to a certain percentage for the loss that you experience if the customer is putting down less than 20%. So that's where mortgage insurance came from. It was a way for customers to put down less money, lenders to lend out more funds, and then the insurance company covers some of that risk between the 20% and maybe the 5% down. All right. So a lot of people say, well, I don't want to pay mortgage insurance. It's just an empty cost. I don't want to do that. Why would I do it? And the big answer for why you would do it is so that you can put down a smaller down payment. Many of my customers do have 20% down or more. Many of my customers don't. Some have 5% or 10% or even 3.5%. So the big benefit for mortgage insurance for the customer is the ability to put down less money. You don't have to save up for the next 5 or 10 years to get your 20% down. Now, there's going to be some really specific nuances between FHA and conventional. We're going to talk about that a lot in detail next week. Also, a big question I get is ways to avoid mortgage insurance. That's a popular phrase that I hear from people that don't want to pay that. We're going to talk about that in depth next week as well. So thanks for watching today, guys. We're going to cover in depth next week mortgage insurance, how the premiums work, what are the dollar amounts, ways to calculate it. So really want to get some good info for you on that. But hopefully this kind of breaks the ice about why it's required, what it's used for, and who it's covering. If you have any questions, please feel free to give me a call, 303-809-7769, or of course email me, jmassey@castlecook.com. Have a great weekend, and I will talk to you guys soon.